Running a little bit over, so I want to bring us back to the agenda. Apologies for cutting off some of the conversation, because I mean that's what's so great about meeting in person. But there'll be more time for that. So the next item on the agenda is our quarterly report from Empower. We have Gabe in the house, members online. We have Rob as well. So should I turn right over to Gabe?
I think we can turn it
Okay.
over to Gabe.
Very good.
The floor is yours.
Thank you so much, Eric, Mr. Chair, and so wonderful to see all of you. It's been way too long, but to be back in person is just absolutely wonderful. And yes, Rob and I contributed quite a bit to your economy last night. So we really appreciated, we really like it to come up here and spend some money, including Mother's Day gift, shopping at the cider mill. So a lot of good stuff there. So thank you for that. But in all seriousness, it's wonderful to be here with you. We've got the Prudential team here as well. We've got Joe Fine, the investment consultants. Chip is out on vacation, but we've got Owen and Brian here as well to give some comments on the field report. Melissa Trument, our CSM, Kristen Green, our communications director. And I'd like to introduce one of our senior executives in the government space, as well as my boss, so you can say whatever you want to him, Rob Luciani. And this is Rob's first meeting here with you all at the board. So what I wanted to do, just to keep this moving, was I was going to share some observations of what we're seeing in the marketplace today. Then I was going to cover some metrics for your plan. When I get into the metrics, there's two new slides in the plan that you guys have not seen before that I've just seen for the first time. And there's some annual information there that I think will be very, very relevant as we continue with our relationship now, working with your consultant RVK on a lot of the information. So we look very much forward to partnering with them and going forward on this relationship with our new contract. So any questions or anything you guys have top of mind before I get into observations? Very good. Keyword, volatility, and we're seeing a lot of it. You're going to hear a lot of that from the investment reviews and primarily what we're seeing from participants. These markets, obviously, and when you see the performance results, will reflect that. But there's a lot of anxiety out there for participants. They're still struggling paycheck to paycheck. The cost now, tariffs, everything that's happening, impacting them. A lot of surprises to some individuals, not to others. But it is a very challenging time in the volatility. The good news is what we're seeing across our book of business at Empower is that participants are staying the course, which is really, really good news. Now, it could be a combination of participants have been numb to the fact that all the volatility we had over the last couple of years, more and more participants are getting educated. More participants understand this is a retirement account, and more participants are saying, you know what, stay the course. Later on, when Gillis comes on the phone, I want him to share some what he's hearing from your participants and members. And I think one of the things that surprised me, not to steal his thunder, is that some participants utilize the volatility as an opportunity to get more aggressive. But I'll let Gillis talk a little bit about that at some point in time. Yeah, that's exactly right, Jay. That's exactly right. Thank you. So let's take a look at your plan here real quickly. And Melissa's got it up there on the board if you want to look at that. I'm just going to make some quick commentary here. As of the end of the first quarter, as of March 31st, your plan assets were $723.9 million, representing 9,342 accounts. Fast forward to yesterday's close, 727.5 million. So obviously volatility. I mean, millions of dollars are moving just within a matter of days and months now, so to speak. In terms of your average account balance in your plan on the next page, on page 4, again, your plan's at 77,004. Benchmark is at 70,000 and the top 10%, and you'll see some trending information there. In terms of how people are investing their money, we're going to look at some investment strategies, how they invest their money, and then obviously some of the funds themselves. And Joe Fine will cover some of the performance and market observations for that plan.
Let me interrupt you, Gabe.
Absolutely.
Struck this time, I've noticed it before, but really struck this time by the difference between the mean and the median on participant balances. And from my point of view, the median is a lot more important number than that average. That average, you know, it looks like a nice healthy number. Yeah. But it's clearly reflecting a very small number of very large accounts way out at the tail of the distribution. Yeah. because the median is so much below it.
Agreed. Agreed. And unfortunately, you'll have that situation when you have, there are individuals with $1 million balances, and then it doesn't reflect reality
Right.
for the masses.
Right.
Again, it's just math, right?
Yeah.
And then you try to extrapolate from there. But I'd like to go to page 5 on our presentation, because this is a new page. And again, this is really interesting. Looking at your plan, first of all, 58%, that says 5,400 out of 400 accounts, they've registered their account online. And as a reminder, registering an account is good. It protects you, authentication, all that good stuff. So that's a good trend, but we can do better. And as you can see, quarter over quarter, how we've increased that. So again, a lot of this data will then allow us to work with our communication, say, what do we need to target? Working with RVK and their thought leadership on that aspect, and how can we partner together to say, what does this data mean and where do we need to focus, right? So registration being one of those areas. But what was more important to me is when we looked at the participant information, how there are 1,000 participants in your plan that are not registered. They've not registered their account. We have individuals, no personal email, no work email, no mobile phone numbers, no home. That off the top would say, well, it's an area of concern. But when you start to look at that in the government space, you're not going to get everybody. There are participants that have retired that have account balances that don't have an email and simply just get a paper statement. And the only time we hear from them is when they call, or if their address changes, we attempt to try to find their address and then freeze the account. And unfortunately, sadly, when we do hear, it's from someone that says Aunt Sally passed, for example. So, we can target and do certain things to try to get those numbers up. But this is a good, to me, eye-opener, right? Yes, Commissioner. Hi.
Oh, sorry.
No, not at all.
Is this since the change back to Empower, or is this if they had logged on through previously through Prudential, did it change over?
This is going to be Prudential's data came over.
Okay.
So it's all here.
So if you logged in under Prudential, you count.
Correct.
Because I was going to pay, I haven't logged in under Empower.
So Commissioner, let me point you out to say you're one of the 300. Thank you for being honest about it. You're one of the 3577s on this report. Thank you very much. That's never logged in.
No, I've logged in before when it was under Prudential.
Well, no, this is registration.
This is after.
This is
People,
Okay.
people as part of the migration.
I'm pretty sure
These are
Okay.
folks that went ahead and did the right thing after. Yeah, we're not picking anybody.
No.
So Commissioner, it'll
Wait
be.
a while till I had you work at the King.
I will tell you,
You had a note
Commissioner.
on here that you didn't. I'm
know.
just kidding. I wasn't going to say.
But it's really, really important to get the message out, how important it is to register your account, because it's not just registering your account, but it's about setting up your beneficiary.
No,
making
I
sure
was going
all
to
of
see
your
if
data
I
is
could
correct.
just do it right now. I'm like, probably it's not a good idea.
Well, you got to get a text in your phone and all that good stuff.
Maybe I'll just wait.
I will tell you what this is in all,
Maybe I'm lying, maybe
in all seriousness. If you've never logged on or did anything with this plan, I highly encourage you to make an appointment with Gillis or Brian. Just reach out to them and say, hey, let's do a review here real quickly.
No,
and-
just
and
not
go
since
through all
the
of that.
new switch over. I just
Yeah.
never.
But there are so many new tools. One of the pages, it's probably the next page here. If we go to next page real quickly on page 6, it's the lifetime income score. It's basically an income replacement ratio, right? Where we look at 70 or 80%. But when we look at this plan in particularly, the median's at 57, Jay, to your point. This is based on 2,023 participants that went through the exercise.
Yeah.
So if you log on to your account, go through the exercise just to kind of see where you stand. The more people that do it, it'll be reflected in those numbers, right? So we encourage people to look at that. And then there's a lot of historical information there versus benchmarking peers, et cetera.
Able to break out active versus no longer actively
Yeah.
working
Yes.
in these numbers, and how many active participants do we have?
Well, I'll get to that slide in a moment, if that's okay with you. Yeah.
Sorry, I.
No, not at all. I want to look at cash flow on page 8 here real quickly. So during the quarter, and again, you could see the 4 previous quarters, right? We had $9.9 million coming in total contributions, 13.2 in distributions, and we'll look at distributions next. So we had $4.2 million in net negative cash flow for the position, for the period, excuse me. But where I want to focus your attention on is the second to bottom line there, change in value. That's market appreciation valuation. As you can see in the first quarter, minus 4 million. That's a reflection of the market activity, right? So versus look at the third quarter, if you will. We had 40 million plus, so talk about volatility, right? And just the last 6 months or so. So participants are rightly anxious and nervous about that. And we're going to start peeling the onion back a little bit. When we look at contributions, as you can see on the next page, on page 9, we had that total of that $9 million. Well, 6.2 million was deferrals, regular deferrals, and another 1.6 in Roth contributions, which seems to be very popular. And then the 1.2 other, that's rollovers into the plan. So when participants are being hired, they have, or people that have been in the plan, have outside assets, they're working with Chip and team to say, hey, how do we consolidate these assets rollovers into the plan? And then there's the rolling 12-month period there for you. And then you can see a month-over-month run rate on the bottom of that, on the chart for your reference. And then contribution activity and insights will pass on that. Let's look at distributions going out of the plan, because there's going to be a new slide here that I want to share with you. Excuse me, and I apologize, I have a dry cough. I'm on the tail end of something. So for year to date, for the first quarter, we had 13 million come out of that plan, broken down by various transactions and distribution types, as you can see. 12 million separation from service, that's the bulk of it, right? But we had some required minimum distributions, some hardships, service credits, qualified domestic relations order, and sadly 34 transactions representing death distributions over the period. And again, the rolling 12 months, and I'm going to get to that rolling 12 months in a minute there for you. On the new page is, if you go 13, page 14, it's called a money in motion report. This is the first time you all are seeing it, and we run this on an annual basis. And I've shared this with RBK as well for their analysis. But this is really, really telling, right? A lot of times people say, well, you've got all those distributions. Where's it going? Hey, what's going on? Well, this is a full year of 24. So it's a full calendar year of 24. $63.7 million were distributed from the plan. How does that break down? Almost 30 million was rolled over to external accounts. 30 million. Wow. Okay. Where to go? Look at the top 10 external distributions. 16% or almost 5 million went to Charles Schwab, Edward Jones, Fidelity, LPL, et cetera, et cetera, et cetera. So this is a good barometer of where's money going? Why are people moving their money? I'm excited to see that 36% or 23 million stayed in the plan. Right? Clearly, an objective is to keep the money in the plan and the benefits of doing so. So that tells us, do we have the right messaging in helping employees understand that they can stay in the plan? Believe it or not, a lot of participants still think, oh, I'm leaving, I can take my money, I'm out. You don't have to, which is important. Why? To have a message, a meeting with some of our representatives to understand and go through all the distribution options. And then how many were cash outs and how many rolled to an Empower IRA, almost 5 million. And then rolled to an Empower plan is people that moved money to another plan. They went to work for another organization where Empower still has their assets. So this is new to you, all of you, but we're going to keep an eye on this and to kind of see where the money's going, right? Yeah, it really is. It says you can extrapolate a lot from that, but this also validates what we've been seeing, and you've heard me talk about over the last year or two, is that we saw a big exit of retirees, right? And a lot of people took their money and moved, right? They're consolidating their assets. Why are they consolidating their assets? Well, there's a lot of factors that go into that. But, people and their spouses and their partners that consolidate their assets and all that. But what they're doing is they're going to financial companies where somebody's managing their money for them, right? Why are they managing? Because they can get advice, right? Well, now you can get some advice in the plan. You could pay for it a lot less than a retail account, for example. But these are just options for participants to choose from. Look, this is voluntary money. We know that, right? Participants have built up for this as plans grow and people get mature. That's what they want to do. But what is important is, are they using the retirement assets with installments as it's intended? What is a purpose, individual's motive? That varies. But we want to make sure that participants understand all of the options that are available to them, and then they make the decision, right, on what's best for them. Our focus.
Do you
yes.
follow up with people who have left?
Do we? Yes, we do. As a matter of fact, we were just talking about that earlier. So what happens today is we're provided a file from the state on who's terminated. Empower reaches out to those individuals and says, hey, we understand you're terminated.
Who rolled over and other?
Oh, people who rolled over out to someone else?
Yeah.
No. When people roll out, that's it. They're out. We don't go to someone and say, why did you roll over to Fidelity? No, we don't do that. We don't do that. I'm sorry. But we do try to reach out to participants when they're terminated to close the loop on that and help them understand their options or meet with a representative and remind them that they can stay in the plan, because sometimes they say, hey, I've just retired. We'll call you and say, I retired. And they're like, oh yeah, I'm taking my money out. Well, why? You don't have to. Really? and they have that conversation. So we're trying to engage in conversations with people. And then just so as they can make an informed decision, right? And as I've been saying all along for many, many years that you know me, and by the way, thank you for the new contract for the next 5 years, is at the end of the day, it's all about the participant, right? How do we help participants achieve better financial outcomes? The focus always will be on the participant. That is our job, right? Help them achieve financial security, help them achieve better outcomes, making sure the focus is on them. Ultimately, they're going to make the decisions they're going to make, but how do we help them better? That's the goal. That's the goal.
Yeah, I'm just trying to
Yeah.
understand the stay
Yes.
in plan group. So
Yep.
what's captured here is people who have terminated, separated from service, retired. That's the population here. So
Yeah.
stay in plan, they've said, hey, we're keeping my assets.
95 participants that were terminated had a conversation where it says to WPA Service that's talking to the CHIPS team and or Empower saying, I want to leave. And they said, no, you really don't have to. You can stay in the plan. So we count those people. So the 95 are people that were terminated, wanted to know what their options were, but they decided to stay in plan. That's how we captured those people there.
Thank you. Sorry.
Sure. Yeah. Yeah. So that's a new slide, and I hope you found that helpful, and we'll continue to provide that going forward. In terms on page 16, just investment strategy utilization. There's different groups there. So my total retirement is a managed account. It's a for-fee service. And as you can see, there are 450 participants that are utilizing professionally managed accounts. This is the pay service representing $26 million. And then you can see 35 people are using free online advice. Your target date funds is the target date strategy. Your asset allocation is your goal maker. So you could see that approximately 23 and 28, do that math, 50 some odd percent, are utilizing an asset allocation tool. But the majority in this plan are individuals, or 3,900 of them, let's call 4,000 participants, 42% of the assets are people that do their own investment management. They do it themselves. They build their own asset allocation strategies. That's pretty common in the government space because a lot of these plans are older and participants did it their own, but now they're becoming more and more familiar with, the different services that are available with the corresponding dollars and the average balance of those participants in those investment strategies. Jay, you were asking about active and on the next page separated, but this is the investment strategy on how many are active and how they're utilizing their investment strategy. And what's nice here is that you can see of the participants that are separated in the bottom box, if you add those up, quite a few people stay in the plan when they separate service. And, almost 1,000 participants are in an asset allocation. They stay there. 2,000 do their own strategy. So again, a lot of individuals, if you look at these plans that I said, these are voluntary programs. For a lot of people, this is legacy money. This is, once I retire and do what I want to do money, but they're staying in. And the important thing is here is that they're not just taking all that money and putting it in a fixed income fund. What they're doing is they're staying invested through their retirement, capturing the up and downs. So
My earlier question, Gabe, was really about registering accounts and
Yeah.
how many active employees have not registered. So it seems like the outreach might be a little easier to active.
Yeah.
To get them to register.
yeah, we're going to continue to drill down on that. They gave me that total of not registered.
Yeah.
And within that, it could be some people.
Yeah.
I would suspect if you looked at the people that have never done anything, they're probably mostly retired.
Probably, yes. Yeah.
Mostly retired.
Yeah.
Page 18 is kind of just the advisory services and the utilization. As you can see, more and more participants. At some point, this will level out like some of the other programs like GoalMaker, et cetera. But there are 450 participants, a few more than three from year end, wanting to have their accounts professionally managed. And then on the next page, we kind of break it down by demographics. On page 19, people under 30, 42% want their account professionally managed. Well, we're starting to see across our business, the plans that offer this, especially with younger folks, they're more of the mindset of, you know what, I don't have time for this. I want somebody to manage my account for me and I'm willing to pay for it. That's just their mindset. So we're seeing younger entries enroll in these types of programs for the longer term. But then again, you could see the breakdown, 118, 30 to 39, 88, and et cetera, so forth. And the different, the different, whether they're active or separated, and the genders and, assets, et cetera. GoalMaker was the asset allocation tool on the following page. There's about 2,600 participants in GoalMaker, 126. And then again, you see the asset line and the participation line. And that's pretty much, leveled out at about 2,700 now for some time with the initial when it was first implemented 5 years ago.
I just have a quick question on
Yes,
this page on
Which
the
page?
salary runs 19 where we are.
19. Okay.
Yeah. The salary is average/median.
Mhm.
So is that managed account? So looking at the salaries, like what's 453,000? Is that the amount they have in the account for the 50 to 59 years old? Like we don't have employees that make $453,000 a year
Yeah,
at this
right.
stage. So I was just curious as to those.
Do we get salary advice on the file?
Well, it says salary average/median.
Yeah. I don't, again, I don't know. Melissa, do you know if we get salaried on the file? I don't think we do.
We do not. We don't get salary information on the files from the state.
It's a mathematical computation that the system is producing, but I don't know where it's based on. So we will follow up on that,
Okay.
Commissioner. But we do not get salary information. Again, most plans provide us what's called a full census file and data and everything. When we have that, that just works a lot better.
Okay.
If we don't get certain data, we have to rely on whatever the default is and how it's calculated. And I don't know the answer to that
Yeah.
question at this point, but it's a follow-up question that I'm definitely going to dig into. Yeah, sure. And then we had GoalMaker participation, and then the strategies and assets, and then on the assets in GoalMaker versus the non-GoalMaker. I want to take you to the asset allocation by fund right now, real quickly. On page 24 and 25 is just a snapshot of all of your funds as of the first quarter of 24, and as a look back to the versus the first quarter of 25. So on page 24, you have all your investments in the plan, the balances, the percentages, the number of participants in those strategies. And then on page 25 is the remaining funds. The comment I'll make here is that you've got 117 million in your stable value fund. It's about 15% of the assets. It's actually gone down since that, which further tells you that people are staying the course. They're not all bailing out, so to speak. But more importantly,
The
it's
other proof point is on page 24, the top, you see T. Rowe Price, your target date funds. The number is pretty consistent from one last year to this year. So people are not that are in asset allocation strategies, either it's MTR, it's GoalMaker, which is on page 20, or target date funds, they're staying put.
yeah, they stay the course.
That's what's wonderful to see. Even through all this market craziness, people have got, Gabe said, they've gotten the message, especially those that are using an asset allocation tool.
And then on page 27 and 28, I'm just going to wrap it up here. There's just some participant insight, quarter over quarter. When we look at the 457 plan, how many people are by ages eligible, what they're contributing, their assets, et cetera, so forth. Just some statistics for your reference. Any questions on the 457 before I just pivot to the SDA? I usually give my 2 cents on the SDA, and then I'm going to turn over to Joe to give us an investment review.
I just did some back of the envelope math
Hi, Bruce.
about participants, and it looks like over last year, 4% more participants
Yeah.
than when we started with, which for me, that's a really good metric that people are being engaged, employees are being engaged and contributing to these accounts, which are
Yeah.
great. So I just want to thank you and your staff for going out and doing these events in person,
Yeah.
like you mentioned in previous quarters. And
Yeah.
if there's any way that we can help with that, I think that would be a great way to strengthen the
Bruce,
plan.
thank you so much. I know Chip's not here, but Chip is here quite a bit. Good morning. And we spend a lot of time with Kristen, and we're going to be working with RVK in terms of how we're meeting with your participants. And so especially new enrollees and they get out into the field and try to share the word that the importance of this benefit and get new enrollees, because one of the things we're seeing across the business is the government entities are not expanding fast. In fact, quite honestly, they're contracting, right? So when we get a couple hundred new employees, that's kudos to the team getting out there and explaining that. So thank you, Bruce. But we'll be doing more on that as well. I appreciate that. Good morning. On the SDIA account, real quickly, again, as a reminder, this is the single deposit investment account. There's no contributions into this plan. Next page, $21.4 million representing 700 accounts. And it's only distributions, as you can see here, Again, quarter over quarter, it looks like a run rate of about, in terms of disbursements out of the plan, about $500,000 for this quarter versus $1,450,000. You could see there, so 21,000. It's all separation for service. These are individuals that were eligible. Some were RMDs. Unfortunately, some were death payments on the following page. But that's just a wasting trust, to say it any other way. Just a report on that as well. Any questions for me? Because I'd like to hand it over to Joe Fine to give us an update on the investment report. Very good. Thank you for sharing, Melissa. Joe, take it away. You're up. And then after Joe, I'm going to pivot to Owen just to give us an update on what your participants are doing and some of the activities. And then from Owen, some final thoughts from Rob on what Empower's doing in terms of in the space, right? In terms of thought leadership. So, Joe, take it away, sir. Make sure we're still on time here.
Thank you, Gabe. Hi, everyone. Good to see everyone again. Second. Okay, so well, everyone can see my screen. Yes, just someone give me a verbal shout
yes,
out.
Joe, we're good.
Yeah, thank you.
Yep.
So market backdrop, as Gabe spoke about, and be remiss if I didn't say, also looking forward to working with our VK in the future, to the extent they're doing things a bit differently than we are. However, they'll also be talking about volatility, right? So that being said, if you close your eyes on March 31st and open them this morning, you would think nothing happened. The S&P is actually up about 50 basis points since the end of the quarter, and it's up again this morning. But as we know, a lot has gone on between that time. So pretty much summarizing here on page 4, sort of the middle bullet on the economy here. We did have negative GDP growth for the first quarter, as we now know. It was 100% due to the level of imports that accelerated in anticipation of tariffs coming through. So the way GDP is calculated, imports are an input to that, and that's why GDP was negative for the quarter, as opposed to slowdown in domestic activity, so to speak. And as you probably heard, there is a trade agreement reached with the UK. Talks are beginning with China. So hopefully the tariff rhetoric will settle down, but obviously remains to be seen. So that's really what's been driving markets most recently. So I'll get to what we saw for the quarter. Again, the numbers aren't much different since the end of the quarter, just slightly better. And
Page
certain
6.
things that, yeah, oh yes, thank you, Gabe. Sorry, page 6. Certain things did change. We'll speak to that impacted 3 of the funds we're going to speak to. But you could see negative returns for U.S. equities. Interestingly, growth underperformed value, right, due to the tariff rhetoric, AI news. Mag 7 got, the Magnificent 7 got hit really hard in the first quarter. This has since reversed since the end of the quarter. Growth has come back more than value, if you will, but still behind year to date. And just scrolling down, you will see that international markets did better than U.S. markets as well. Bonds were positive for the quarter and year to date. Not a lot has changed there since the end of the quarter. And not going to speak to this because RVK has a very similar, if not identical, slide. So they will speak to the market volatility that we've seen. You could see the picture here and some of the events that have occurred this year leading up to it. But let's get right into the funds. And as we normally do, we sort of peruse pages 30 to 33, 30 to 34, and we stop and pause on funds that have underperformed for the 3 and or 5 year period. And if we do that, we begin towards the bottom of page 30 with impact sustainable allocation. You could see the fund for the quarter was behind benchmark, behind the peer group median, and didn't have a great 24. So that's all leading to these trailing returns falling behind. The good news is if we look today, again, because of some of the dynamics that have changed with respect to growth stocks, the fund is now in the top half of its peer group for the year to date. The trailing numbers are still off, but it's good to see some improvement there. Similarly, at the top of page 32, I should be blowing these numbers up. Apologies. I know this is hard to see. The Vanguard US Growth Fund, you could see slight underperformance relative to the benchmark for the quarter, underperformance relative to the peer group, but still good on a trailing 1 year basis. The 3 and 5 year returns are not good relative to peer group. If we look today, the year-to-date numbers have improved somewhat. And the good news is, because of the way these trailing returns work, have a bad quarter on the back end rolling off, the 3 year number would be in the top half of the peer group. So we wouldn't, if we ran the report as of today, we wouldn't have even been speaking to the fund necessarily. Similarly, towards the bottom, at the very bottom of this page, we've got the Impact Global Environmental Fund. Again, this is a fund that has improved since the end of the quarter because of information technology being the primary detractor for the quarter. Since the end of the quarter, that has reversed, and this fund is now in the top half of its peer group. And the trailing numbers are off because it had a really poor 2024. And then, and again, there are written comments about these 3 funds on page 35. So the last fund did want to speak to, just a reminder to everyone that kudos to the board, the patience that was exercised with the Lazard Emerging Markets offering. Those that have been on the board for several years may remember how awful this fund looked on a trailing basis. And now look at the run the fund has been on. So that is great to see. And I think I will end the prepared marks there. Questions, comments?
Always good to end on a high note, right?
Yeah.
Jill, thank you very much. Appreciate that. Gillis, I know you're covering for Chip, but if you would mind kind of just sharing some of the activities and kind of what you're hearing. I know I did tease you a little bit with what some participants are viewing the volatility here. So maybe you can share some more information for the board, please.
Yeah, definitely. The volatility's spurred a lot of action, a lot of meetings, but I would say the biggest thing, when we had those meetings with the participants, we're bringing through what we call a retirement readiness review, which is very kind of methodical approach to kind of helping them understand that more holistic picture. So instead of just worrying about the current market conditions, kind of helping them understand all the different moving pieces. So going through the benefits like dollar cost averaging, helping them understand every 2 weeks, right, every pay period, that contribution now is buying more shares at that lower share price. So before maybe they're coming to the conversation, like maybe I want to stop my contributions. Why do I contribute to something when it's just losing money? Help them kind of understand that bigger piece of the picture for them. And also to being diversified, making sure they're proper allocated there, showing the benefits of the different performance, right? Maybe that international fund's doing well now where it's been lagging those last couple of years, making sure too that they're, on track through the process as well. Having those conversations, kind of helping them understand that bigger picture, not looking at such a short time frame, but then too, if they're not retiring for another 10, 15 years, just kind of help them step back from the ledge, help them understand that bigger picture, and really just kind of helps, relieve a lot of their anxiety, having us here to have those conversations with, and really just kind of helps along the way. Then actually too, we do have a statewide webinar coming up next week on market volatility. So thanks to Beth and Kristen that get out to all the state employees in the HR newsletter there. Brian out too will be sending out the invite information too to all of our contacts across the state. So something where not only we're having those individual conversations, but even to having that wider reach on those webinars as well, just in response to all of that. It's a great thing kind of on the outreach part of it, but at the same time, having all those participants, kind of helping them relax, looking at that bigger picture makes things a lot easier for sure. Unless anyone has any questions for me, I'll just kick it back over to Gabe.
Yeah, Brian, we were having a conversation about some participants, and we're seeing it here in Vermont as well as other places. But some participants are actually, when they're doing their registered review, given the volatility, they're saying, should I be buying more? They're actually, some are being more aggressive in their asset allocation. And I know you and I spoke about that.
Yeah, going back to that dollar cost averaging, helping them understand that. That's where it's a lot of people come into those conversations. Most of them are kind of thinking about stopping contributing. Then after that conversation, like, oh, I'm buying more shares during this accumulation phase. They're increasing the deferral increases right there. So again, helping them understand that bigger picture goes a long way.
That's great. That tells you people are starting to understand these concepts. Well, before, it was, I'm just going to turn it off or either just reduce it. But now they're thinking about, this is a buy. Could this be a buying opportunity? So those are good conversations.
Stable value funds going down. That means people are deploying capital.
Well, yeah, that's exactly right. People are going to redeploy capital. Remember, stable values is part of Goalmaker, so that rebalances all. But it's not jumping really high where people are in markets past. Everybody moved to stable value. We're not seeing that, right? And that's exactly what you want to see, not see that type of move. Thank you, Gillis. Any questions for Gillis? Yes, hi.
Just observation. I'm wondering if the webinar on market volatility or future webinars, if there's a way we could maybe get that information out to retirees who are in the plan too.
I believe it does go to, could you speak to that? I don't want to jump ahead, but the question was, do retirees participate in webinars and how do they get that information? I'll let you or Kristen speak to that.
There was a list we could get. Some type of email domain that we could send to. Yeah, we'd love to blast it out to them.
Yeah, but
for us is we had not previously collected retiree emails, and that's something we've been building as over the past couple of years. That's now a regular thing. We're asking folks as they're retiring to try and get a reasonable list of retiree email address.
Yeah, so that also ties to the registration, Tim. Excuse me real quick. That just ties to the registration. When people register, they give us, a lot of them give us their personal email address. When we have that personal email address, when we deploy webinars, they get it.
Okay.
So they get it. So when people give us the data, they get it. So
we could encourage, for instance, in our newsletter.
Absolutely. And I think we do that with newsletters. We do work with staff on newsletters on some information. Isn't that correct? I believe that's what we do.
Yeah, we could do both. We could actually put information about the
If you
webinar
got it
in
to
it.
me, we would put it in our newsletter.
Because your newsletter's quarterly, right?
Well, three times a year
now,
and once it goes to everyone who's retired.
Yeah.
And so that would be the one to get it in. That's a 7,000 plus mail.
Excellent. Work with Chris on that to make sure we get that stuff to you. But
Thank you.
But participants that do register when we have it, they get it.
Yeah.
But can we do more? Absolutely. Okay,
Great.
excellent. Thank you. Thank you for the question. Any other questions?
And we do have recorded, pre-recorded webinars also that we could, as part of that, we could link to a recorded market volatility session as part of that outreach to retirees.
Perfect.
And
Wonderful.
then with a call to action to, check in with their retirement plan advisor.
Excellent. Yeah, we'll spend some time on that next week when I return, Kristen. Thank you. Thank you for the call. On the final, real quickly here, Rob Luciani, Bill, can you share the one page here? And Rob is going to speak to some of Empower's thought leadership in terms of what we're doing in the government space. Just going to provide you just a high level summary.
Well, Gabe told me if I was to come along, I needed to do something. So I figured I would at least share this, that, on the theme of kind of what's a little bit different with Empower than Prudential. We're a much larger government focused organization now, right? We're the largest provider of government retirement plans in the country. So we have a lot more ability to do things like a thought leadership piece. So we do this every year. The latest one I have up on the screen here now that's available. This one was done it was a unique study done on 1.9 million participants across the government sectors to learn how people in individual groups are kind of acting. So we're talking people that are utility workers, they work in schools, they are everything from public safety, actually by gender, seeing what those folks do. And it's a deep dive into that. That's an example of our latest one. We do this every year. We're also about to issue another one, which is titled Integrating Mental Health and Financial Wellness. We're going to be doing a webinar as well as a full study on this, because we've heard from, again, and I mean, it's a very timely topic. People are stressed on a lot of things, and mental well-being and financial well-being kind of are linked together in a lot of ways, like it or not. That new study's coming out. I think we also have a segment at MAGDA, which is the largest government yeah, thank you. Yeah, I'm not even going to go into, these are all available. They're available on our website. We can get them to folks if they need them. So those are kind of more the thought leadership pieces. We also, speaking of what Gillis had mentioned, participants are bombarded constantly with hearing a lot of just negative things everywhere. Well, at the same time, we want to try to offset some of that with just learning, having them get the real details of things. Recently, we launched a whole series of short videos. We hired a woman by the name of Marta Norton, who's the former CIO of Morningstar. She's now part of Empower. She does these short, focused videos. Every time there's a timely kind of news event, if there's a tariffs being announced, with the Fed minutes, things that come out, she does these very short videos that are available, that are focused, that allow for plan sponsors as well as participants to hear kind of we'll call it unbiased, but a true view of kind of how this might impact things. And it allows participants maybe to have a little bit of a different focus as opposed to hearing kind of who's pulling at them in what direction for some specific reason. Also, Vanessa Welch, we just hired as well. She's an award-winning journalist, so you'll see her name out there representing Empower. You also see, of course, Ed Murphy, our chairman. I guess that's our title, right? These days. He's out on a number of different news channels doing the same thing. So that's things that are out there. And finally, just wanted to mention there's a newsletter that we have available. It's called The Currency. And it is a newsletter purposely. There's no Empower ads in it. There's no product placement. This is truly nothing that's is helping a participant kind of learn about something that Empower offers, other than timely, we'll call it focused articles around what participants might care about beyond just their retirement plan. The one just came out, just got in my email today. It focuses on 3 topics: college prep, passing the baton on a family business, and gold being at a historic high. So it's just these general kind of not retirement stuff that people tend to like to read. That's something that's available. We're putting on as well. These are things Prudential didn't have, so they're new with Empower. And Gabe had mentioned a couple new pieces in the report that were new. I thought I'd at least mention some new things that Empower has that Prudential did not. That was it? That's short enough.
Thank you. Actually, okay. It's not actually related to Empower per se, but these portfolios don't have a cash. Is that correct?
No,
just curious
well,
why they
there's
don't.
money markets. There's money market funds.
Yeah, but what about treasury
But there's no
Bond.
I mean, for those
Like
people-
cash, like a bank account, cash CDs, that kind of stuff.
For
Or
those people who want to reduce their risk entirely.
Right.
The only thing available, I think, is stable value,
that's the only protected. Yeah.
which is not low. I mean, it's lower risk, but it's not.
Most
Curious why
most retirement plans don't have a cash account because it's long term, but that's probably a better question for RVK based on what they see. And I think in their role, They can speak to more of why is it not in plan? Should it be in a plan, et cetera. So unless you want to speak to now, otherwise, when they present, that's something that they can address. Okay, but we don't know. Absolutely. We appreciate these questions. This is so important to all of us to make sure we're all aligned. So thank you for that. Well, so as Mr. Chairman, back to you. I'll just say on behalf of all of us at Empower and the team on the phone here, thank you all for the trust and the confidence you place in us. Thank you for allowing us to serve your participants and your retirees. We greatly appreciate. Tim, we can move and okay. So thank you for all of us at Empower. Back to you, Mr. Oh, I'm sorry. Was there another
I
question?
just wanted to say,
I'm so
I
sorry.
think I just heard 3 Empower presentations without administrative costs being cited or compared to others. Can you just give a couple words on that?
Again, that's
Might
going to be,
also be-
that's going to be
okay.
really good for
I
RVK.
can wait.
Yeah, good, but fair.
Thank you for all the service you provide to the members of our supplemental retirement plans.
Thank you.
Thank you for being here and communication and all the work you're doing sort of, out on the forefront, new products and so forth, new ways of communicating with members. Thank you.
Thank you, Eric. Appreciate it.
That concludes the Empower quarterly report. We are running a little behind schedule. Next up is RVK. Tim, would you like to introduce RVK?
I'll take it off from a little housekeeping perspective. We'll try and get this wrapped by noon or shortly thereafter, and the staff side of it can be relatively brief. We can condense the last item. We have our new partners from RVK here. We're extremely excited about to help us with our oversight of these plans, and specifically, it was as if Adam and John teed this up with their questions to help us with questions like fund lineup, like plan cost benchmark, things like that. So to level set, most will remember that a year ago, Jonathan and Sarah and others did a one-time review of our plan to look at our investment fund lineup, our governance practices, and things like that, and to help us kind of understand where we are against peers and some of the work that we need to do. We believe that this was a service that we should retain on an ongoing basis, particularly to make sure that our governance practices remain current and that our investment fund lineup as things change is robust and serving our members well. So we went through the whole contracting process, finalized our contract with RVK, and we've had some kickoff work. They're going to walk through a few comments on the market volatility, but also a high level of what our initial vision of a work plan is. You'll see in the slides, it's a proposed work plan. Any comments, suggestions, of course, welcome. And with that, I'll turn it over to Jonathan and Sarah.
Really appreciate the warm introduction and the opportunity to be here with you today. Just very briefly, RVK is an independent investment consultant you're familiar with. We're thrilled to have the opportunity to build upon the initial project relationship with an ongoing relationship, to work closely with you and the related supplemental plans in Vermont to be able to provide support with a kind of, I would say, a shared vision that focuses in on governance, focuses in on the overall benchmarking and enhancements, monitoring, streamlining dashboard-based reporting, but effectively being an extension of your staff from the standpoint of comparative information and to the exact points that were mentioned. I think that within perhaps the work plan comments, we can talk a little bit about the specific questions about both a money market fund versus stable value and kind of how that, what administrative and menu considerations that might introduce. And then as well, just specifically talking about benchmarking, I think that's perfectly in line there. We've identified 6 specific areas of focus that are up on the slide, the first 3 here. I'm going to be brief from the standpoint because Sarah, my colleague here, and kind of Sarah's the kind of day-to-day lead on the strategic advisor from the standpoint of administrative operations governance topics. We're a team here to be able to provide support to you and the other boards, frankly, looking at the plans on an independent basis in partnership with your talented staff, as well as other stakeholders like Empower. specifically with the first three that we've got here, I'm not going to read the bullets on this, but I think the work plan will actually talk into some of the specific elements a little bit more. But the first one, really fundamentally, the goal of enhancing participant outcomes is a shared goal of ours. And as we're looking at this, we have viewpoints on governance oversight approaches that we are looking forward to sharing with you, comparative best practices, potential options and kind of viewpoints from an independent standpoint, additional perspective on plan enhancements, fiduciary support, whether or not that's training, whether or not that's guidance and education from additional points of view that we've obtained over the years with our shared plans. And then looking at the second measure is really evaluating plan competitiveness. This is really a monitoring role and assessments and benchmarks. We are where data exists, we are very data driven. Where data doesn't exist, we look to identify multiple facets that help us guide a qualitative point of view and perspective that ideally as data can be obtained and data driven decisions can be done, we look to do that as possible. From the standpoint of support for administrative functions, you have a very high quality and competitive relationship that's been validated with an extended relationship with your record keeper. They're a very talented and capable administrative partner. On an ongoing basis, there are enhancements, there are changes, there are opportunities to do different things, whether or not that's in reaction to regulatory changes or whether or not that's in reaction to options that you could consider. Consider us an extension of staff partner in that role to be able to provide support in that vein. Moving us forward to the next one from a consolidated reporting standpoint, we don't want to just simply give you an additional exactly the same investment comparison. We are looking and working very closely with staff to be able to identify opportunities to enhance dashboards, to give you additional points of view, quantitative and qualitative points of view and perspective from an investment subject matter expert. We believe that there's opportunities to enhance. And so we are building out frameworks that will enhance and complement information that you're getting. Specifically improving participant education and communication services. This is more of a, I think, reiterating kind of the continuous commitment toward the excellence in communication. There's always opportunities to self-assess. And so in this area, working closely with Empower's team on this and your internal resources for strategic engagement plans, we're excited to get our hands increasingly dirty in that. And then, where there's an opportunity to do so without diminishing value, looking at reducing or controlling or at a minimum understanding and well documenting investment expenses and administrative expenses and making sure that there is a detailed understanding and documentation of those factors, both on an absolute and comparative basis. So those are the 6 points at a high level, but I'm going to turn it over to Sarah to really walk
doing that comprehensive review. That gives us a head start, I think, gives us a sense of what your needs are, what your priorities are. But we worked also closely with staff over the last couple of months to really focus on what areas that we think are important priorities for you all to focus on, and we're highlighting a couple of them on the slide in front of you here. I'm not gonna walk you through everything on that list, but maybe I'll just share some of those ideas and our priorities for 2025. But what we're hoping for today mostly is to hear from you all, get your feedback. This is your plan. You understand it better than any of us, and we're really hoping to get your thoughts either today or throughout the year on what you think are important focus areas or important projects for us and staff to work on. And we want this to always be a collaborative relationship. So on this page, we're really identifying some of those focus areas that we think are important to prioritize, given our understanding of the plan. Some of them you'll see are more process-oriented, such as building out the investment policy guidelines or having manager monitoring policies and dashboards for you and for staff. Other areas are items that we discussed during the project work, such as doing investment menu review or doing a plan demographic review, just to understand really the role of the plan participants. We really, after putting together those list of focus areas. We try to work with staff to pull together an agenda. And in that agenda, what we really were trying to do is think about the most logical way to sequence some of those items in a way that we start first with more foundational items. Some of them will be highlighted in green here that we've started working on this year. So doing our timing readiness review, similar to what Empower is actually doing with participants, but this is taking a step back and looking at the plan itself, looking at pension benefits and other benefits available to participants, how they behave, what role it plays for them, trying to understand how this should inform everything else we do with you all in terms of communication, strategy, investment menu, target date, design, etc. So this is a foundational review we'll start working on soon with Empower. Another good priority is doing a governance review and developing the policy statements, as I said, also foundational, and I think it will inform everything else we do, but it will also help us document all the great fiduciary work you all are already doing today with staff and Empower. We're also working behind the scenes with staff on a number of additional projects, such as building out the report. I think is a top priority for us now. A custom report that is actionable and that is relevant for you all. And we're open to your feedback and comments also once we create that first report and share it with you all at hopefully the next meeting. We're also working on a number of additional review items, such as identifying opportunities to maybe move toward lower investment vehicles in certain options. Doing a managed account review is one item we discussed and work on closely with Empower on, and then a planned fee benchmarking. Some of those items may not make their way to your agenda necessarily, depending, because you all have other things you're working on. So we will, any recommendations we may have, we'll present to you all, but we are gonna provide you with a status update on items we're working on with staff at every meeting, regardless. Ultimately, I think maybe I want to leave you with that this is not really meant to be a hard plan. So after you all take a look at it, please let us know your thoughts and feedback. And this will be a living document for us all to adjust and modify, and it will evolve depending on what we learn and what changes are about the plan. You and staff are really doing a lot of great work already, and trying to make the plans cost effective and efficient and create a supportive environment for folks. And we're here to help. We also work with a lot of different plans that are trying to do the same thing. And our role here is simply to partner with you all to help you achieve your goals. And we just want to know the best way we can do that.
So I think if I could jump in on that too, please. Part of today is moving somewhat quickly because I wanted to introduce folks, and we had this opportunity to be in person, so I wanted people to get to know folks. I'm always here either individually if there are thoughts on this, or we could put this as another agenda item to talk about, bring our partners from RVK and on online if we want to have a more robust kind of what do we want out of this. But we'll be bringing proposals over the next 6 months and different reporting frameworks for folks. And so however you have feedback, feel free to reach out.
If I could just revisit the two specific questions that came up from the previous presentation. John, you had asked about essentially administrative costs. And, I think that was part of our initial work. It looks like that'll be in the work plan. What's the frequency of that?
So this is something we recommend doing annually.
Okay.
RVK gets data from all our DC clients about their fees and costs, so what participants are paying, but also cost drivers like record keeping costs, administrative costs, our fees, and we benchmark plans against peers that are similar. So in your case, public plans, larger public plans will be more relevant, and we recommend doing this annually. Don't think a lot will change every year, obviously, but it's good to keep track of market trends where you are and find the opportunities to adjust.
Thank you. And Adam's question about, maybe fits into the investment lineup of having an alternative to a fund built off treasuries. I think is how I would characterize it.
Yeah, I would say that from the standpoint of having a money market fund or a treasury or government oriented money market vehicle or like a cash or for instance, other situations where there's like a CD oriented or other type of bank sponsored vehicle. One of the primary considerations that goes into this is, while in the spirit of looking to have a range of lineup options, stable value is not without risk, but it is at the very low end of the risk spectrum. Many plans do have a reasonable consideration and reasonable use of either a stable value or a money market vehicle. In that, the offering one or the other is what we observe is common, and there's typically a division, if you will, of that because of the fact that it can introduce a complication to participants, which is actually just by virtue of the way that stable value fundamentally works with the insurance wrapper that actually provides the ability to go in and out at a dollar. There's what's known as basically a competing fund, if you will, so that you're not arbitraging as a participant the short-term performance experience of fixed income markets going out of stable value fund into a competing option, which could be a money market fund, could even be fixed income, in that there's a restriction on being able to go back in. You have to go into an equity option. So it's known as an equity wash. It's a somewhat jargony technical term, but oftentimes, while it sounds attractive to have government or treasury money market fund alongside or a cash option alongside a stable value, what it actually ends up doing is it creates a communication challenge, an administration challenge, and ultimately the participants that you're trying to give options to, you may actually end up introducing unanticipated or unexpected needs to go into market risk before they can actually get into the actual safer option. So I think fundamentally our point of view on this is really taking a step back and looking at this from a first principle standpoint of the investment menu and looking at offering a range of options going from low risk, it's not no risk, going from low risk to higher levels of risk that give you an ability and your participants an ability to actually make effective asset allocation decisions. So we generally, while we do see situations where there are competing options to stable value offered, it's a point of consideration. So it exists, but it's not without points of concern.
And we've been seeing more clients, especially now that money market fund yield is obviously has been higher than stable value for a while, asking us to do mitigation, specifically taking a deeper dive. There are considerations when you choose between the two in terms of performance volatility over time. So we're happy to do an education on that at some point if it makes sense.
Thank you.
Yeah.
I guess my question was less along the lines of why don't we have a cash option next to a stable value option? My question was more, why do we even have a stable value option? I mean, you have a whole menu of equity choices.
Mm-hmm.
And you also have a menu of fixed income choices from riskier to less risky. It would seem to me that for the world is going to end scenario, that having a cash option would be better than having a stable value option that requires a lot of machinations to manage, almost certainly has a higher fee, and is not, in fact, in the world's going to end, stable. It's got interest rate risk, it's got credit risk. So I don't get that. I don't think the average retiree would, and the idea that it is labeled stable value is, I think, a misnomer. So anyway, it's along those lines that it'd be nice to have a fund for investors who believe either the world's going to end or who want to make asset allocations in a larger portfolio, not just a 401k or a 403b, but in a larger portfolio, particularly as they get closer to retirement age when they have other assets. And anyway, that's the nature of my question.
I think those are very valid points, and I think that they do raise the consideration of, you know, an overall foundational investment philosophy that guides the menu construction. And I think it's a topic that I think bears, you know, more detailed discussion than we might have time explicitly in this meeting. But at the same point, I would say that the, you know, opportunity to look at this, I think there's a number of facets that you can approach this at from a relative performance standpoint over the long term, and how risks can be managed, are managed, and, you know, the menu that the board looks to offer.
On that point, our plan for upcoming work, summer, fall, is to really work on an investment policy statement. And I think from a foundational core beliefs perspective, I think that's a really appropriate time to roll that conversation. So I appreciate that. Thank you. And I'll be following up with the team on that. I wonder, just given the time, if we might just leave the market volatility report for board members review. I think volatility has been the buzzword. It's a fascinating deck with some of the most interesting slides showing the you missed the top 5, 10, 15 trading days in the last number of years, your overall rate of return. It's relatively mind-blowing. So I recommend the report.
Well, market timing fundamentally is very different. It's two right decisions. And I would say that we're, you know, the nutshell, I think, as Tim has mentioned, is that, you know, we actually also would echo what Empower mentioned as well, that we're not seeing participants broadly across multiple record keepers taking, you know, specific, you know, concerning activity. But I think in isolation, individuals may still do that. And so the benefit of having, you know, diversified portfolios in the variety of ways you can get there, but not that's, you know, a target date or a managed account or other solutions is great.
Wonder, connecting with the previous conversation, whether the lack of a cash account actually protects us from people trying to market time.
Still go into stable value.
Yes, I know. And do.
The key to start on this, and one of the core reasons for RBK to be here is, well, whenever a point like that's raised, my first question is, what do most other people do? and that's a piece we didn't quite have as well before. That is really helpful to have the market.
We're thrilled and honored to have the opportunity to work with you and deepen the partnership and relationship. So thank you.
Thank you. Appreciate future meetings and discussions on all of these topics. So that was a really good start. So wrapping up that RBK strategic work plan discussion, next up is disability recommendation for JL. That is in our packets. Bruce?
Chair, I'll move to approve the medical review board's recommendation for Jonathan Leibold.
Second it.
With the motion and a second, it's on the floor. Any discussion on that, on the motion? We need to go into executive session.
I have a question that I don't know whether it's appropriate for open session or not. So.
Well, then.
I move we go into executive session.
So do we have to vote to go in?
Yes.
I would propose the two motions.
Yeah.
Motion one I propose is move that the board find that premature general public knowledge information concerning disability retirement would clearly place the board at application would clearly place the board at a substantial disadvantage.
So moved.
Second.
Okay. So that motion is on the floor. All those in favor, please signify with an aye.
Aye.
All those opposed with a nay.
I'll move that we go into executive session with board members and treasury staff.
There's one more motion, right?
Sorry. The second part is based upon that finding, move that the board go into executive session to discuss the disability retirement matter pursuant to 1 VSA 313.
And I'll add to that with treasury staff.
Second.
A motion that's on the floor. All those in favor, please signify with an aye.
Aye.
All those opposed with a nay. The ayes have it.
Point of privilege, we need to remove.
Yep. I'm on.
Yeah.
You just probably cut it, Bill, and we can come